John Clifton, Jack Bogle was an American investor, business magnate, and philanthropist. He was the founder and chief executive of the Vanguard Group and is credited with popularizing the index fund. John Bogle was born on May 8, 1929, in Montclair, New Jersey. His family was significantly affected by the Great Depression, losing their wealth and having to sell their home. His father fell into alcoholism, which led to his parents' divorce. Bogle and his twin brother, David, initially attended Manasquan High School near the New Jersey shore. Their academic record there enabled them to transfer to Blair Academy on work scholarships. At Blair, Bogle showed a particular aptitude for mathematics. In 1947, Bogle graduated from Blair Academy cum laude and was accepted at Princeton University, where he studied economics and investment. During his university years, Bogle focused his studies on the mutual fund industry. He spent his junior and senior years working on his thesis, The Economic Role of the Investment Company. Bogle graduated magna cum laude from Princeton in 1951. He was soon hired by Walter L. Morgan, founder of the Wellington Fund. Reportedly as a result of Morgan reading his 130-page thesis, Jack Bogle, at Wellington Fund, pioneered the strategy of focusing on a single fund. After his firing following an unsuccessful merger, Bogle founded Vanguard in January 1975. As of April 2023, it has about $7.7 trillion in global assets under management. Bogle named the company Vanguard after British Admiral Horatio Nelson's flagship at the Battle of the Nile in 1798 because he thought it conveyed leadership. Vanguard was founded as an independent, client-owned company. With no outside owners sharing in profits and no sales commissions, it was able to offer low-cost investment services, including the first index mutual fund. Vanguard has a unique ownership structure compared to other investment management companies. The company is owned by its funds, and these funds are in turn owned by the shareholders. This means that the shareholders are the actual owners of Vanguard. Unlike most publicly owned investment firms, Vanguard has no outside investors other than its shareholders. This structure allows Vanguard to focus solely on meeting the investment needs of its clients. With no outside owners to satisfy, Vanguard can focus on keeping costs low for its investors. Because Vanguard's investors are its owners, the company's interests are uniquely aligned with those of its investors. This allows Vanguard to focus on long-term investment strategies rather than quarterly results. It also enables Vanguard to consistently pass along economies of scale and lower the cost of investing, so investors keep more of their returns. This unique structure sets Vanguard apart from most publicly traded investment firms and is a key factor in its ability to offer low-cost index funds. It's part of Vanguard's commitment to helping investors achieve their long-term goals. An index fund is a type of mutual fund or exchange-traded fund, ETF, that aims to mimic the performance of a specific financial market index, such as the S&P 500. This strategy is often referred to as passive investing. Here's how it works. Composition. An index fund is a portfolio of stocks or bonds designed to mimic the composition and performance of a financial market index. It invests in the same assets using the same weights as the target index. Passive investing. Index funds use a passive investing strategy, trading as little as possible to keep costs low. For broad indexes like the S&P 500 that would be impractical or expensive to do on your own, index funds do the work for you by holding a representative sample of the securities. Lower costs. Index funds tend to offer investors lower costs and taxes than some other types of funds. They have lower expenses and fees than actively managed funds. Risk and return. Index funds should match the risk and return of the market based on the theory that, in the long term, the market will outperform any single investment. Index funds are popular for their broad diversification, tax efficiency, and low costs. They are a key part of many investors' portfolios. Vanguard is the largest provider of mutual funds and the second largest provider of exchange-traded funds, ETFs, in the world. In addition to mutual funds and ETFs, Vanguard offers a variety of services including brokerage services, educational account services, financial planning, asset management, and trust services. Several mutual funds managed by Vanguard are ranked at the top of the list of U.S. mutual funds by assets under management. Along with BlackRock and State Street, Vanguard is considered one of the big three index fund managers that play a dominant role in corporate America. Vanguard is unique in that it is owned by the funds managed by the company and is therefore owned by its customers. This structure was part of Bogle's revolutionary idea that an investment company should be run for the sole benefit of its investors. Vanguard offers two classes of most of its funds: investor shares and admiral shares. Admiral shares have slightly lower expense ratios but require a higher minimum investment, often between $3,000 and $100,000 per fund. Bogle introduced the Vanguard 500 fund, which tracks the returns of the S&P 500 and marked the first index fund marketed to retail investors. One of Bogle's pioneering achievements was low-cost investing in mutual funds by creating no-load funds. His 1999 book Common Sense on Mutual Funds, New Imperatives for the Intelligent Investor became a bestseller and is considered a classic within the investment community. Bogle argued for an approach to investing defined by simplicity and common sense. 1. Choose funds with low costs. Bogle emphasized the importance of selecting low-cost index funds, as lower costs can lead to higher returns. 2. Think about the cost of advice. Financial advice can be beneficial, but it's crucial to consider the costs and ensure they're reasonable. 3. Don't rely solely on past fund performance. Bogle cautioned against choosing funds based solely on their past success, as past performance doesn't guarantee future results. 4. Use past performance to assess consistency and risk. While past performance shouldn't be the deciding factor, it can be used to evaluate a fund's consistency and risk level. 5. Be cautious of star fund managers. Star fund managers can come and go, and their success often doesn't repeat. Bogle advised against choosing funds based on the reputation of their managers. 6. Be aware of the size of the asset. Large funds can sometimes be less agile and less able to take advantage of certain opportunities. 7. Avoid owning too many funds. Owning too many funds can lead to over-diversification and make it challenging to manage your portfolio. 8. Buy and hold your fund portfolio. Bogle was a proponent of the buy and hold strategy. He believed in creating a diversified portfolio and holding it for the long term. In the later stages of his life, Jack Bogle continued to be active in the investment world. After serving as CEO of Vanguard until 1996, he transitioned to lead the Bogle Financial Markets Research Center. Here, he engaged in political activism and maintained ties with the SEC, advocating for tightened financial regulations. Despite his success, Bogle never amassed a large personal fortune. He claimed to have low double-digit millions, partly due to his charitable contributions to his alma maters. His generosity and success earned him a spot on the 2004 Time 100 list as a hero and icon, as well as Fortune's 1999 foursome of giants of the 20th century. Bogle remained a critical figure in the investing community, particularly among those who emulate his style and adhere to his famous advice. He passed away on January 16, 2019, at the age of 89. He is survived by his wife, Eve, and 6 children.